So large part of the investors are still exposed to bank deposits. And if you look at the right-hand side, that shows how the bank deposit composition looks like, right? So we're talking about commercial banks here. Roughly about 35% of Sri Lankan population, or the wealth in bank deposits, still lies in current accounts and savings deposits, right? And that 35%, right, roughly earns only average return of about 3%, right? So Sri Lankans have been holding their money in current accounts and savings accounts, or 35% of their wealth in current accounts and savings accounts, even when inflation was at 50% kind of levels, right? So which shows the value deterioration that the investors have seen in the last 2 years, particularly in a period where inflation was very high, right? So it's lack of awareness which kind of has created this impact in terms of less awareness on unit trusts and so on, which why people do not invest too much in alternative asset classes. So what we thought today is we'll create an awareness on the unit trust products, given that it is a product which is yielding a very high return at the moment, right? And is an alternative to your traditional bank deposits as such. Right? So if you look at the chart here, right? So we're comparing what the returns of a savings deposit has been versus the return made by a unit trust account, right? So if you look at the top numbers here, right, that shows if you had invested 100,000 rupees in 2017, right, that 100,000 rupees would have grown to 127,000 rupees at the end of 5 years, right, or 5 or 6 years, right? Similarly, if you had invested that kind of money, I've taken the example of the investment grade fund of Capital Alliance, right? If you had invested 100,000 rupees in 2017, that 100,000 rupees would have increased to an equivalent of roughly about 200,000 rupees at the end of 2022, right? So which shows by just holding on to your money in a traditional savings account, the kind of opportunity loss that you're kind of seeing, right? So what are unit trusts, right? So how the unit trust or the mutual fund concept works is, in a mutual fund, you pool, or basically investment manager pools money from a lot of people. So there'll be people with even 100,000 rupees, 100 rupees, a million rupees, all of them are pooled together, right? And an investment manager creates a pool of funds, right? Which is called the unit trust, right? And that unit trust invests in a diversified portfolio of assets. It can be treasury bills, treasury bonds, bank deposits, equities, real estate. It can be anything, right? Any investable asset class, right? So what is happening here is, for example, as a retail investor, if you didn't have the ability to invest in a product which was not accessible to you before, now you are getting access to it by being part of a portfolio which has exposure to a diverse set of assets, right? Say, for example, right, if you were to buy a treasury bond, right, you should have a minimum of 5 million rupees as an investment, right? So a lot of the investors won't be able to enjoy the returns that the treasury bonds are giving right now, right? So if you look at the last 3-4 months, treasury bonds was one of the highest yielding asset classes, right? But as an individual, you wouldn't have been able to access it if your minimum investment threshold was not meeting the 5 million requirement, right? So you're missing out on opportunities which typically is enjoyed or by larger investors, right? But what happens is, if you are investing via unit trust, because you're being part of a pool which is investing in a large amount of assets, right? Say, for example, if there's thousands of people investing 100,000 rupees, the pool will be about a couple of billion rupees, right? So that fund can effectively buy treasury bonds on behalf of you, right? And you're getting a portion of returns that are made by the fund, right? So you're enjoying the returns made by the treasury bonds also as a retail investor, right? So you wouldn't have been able to access a lot of these products as an individual, right? How many of you have invested in a commercial paper, a securitization, a debenture, right? Many of you all wouldn't have, right? And that's because, first, A, that you don't have too much knowledge on the product. B, that accessibility is very difficult, right? And third one, you need a minimum threshold to invest in these products, right? So which makes it very difficult for smaller investors to take part in asset classes which give a relatively high return, right? But by investing through a unit trust, right, you can get access to these funds because a professional unit trust manager is investing on behalf of you. So he'll be on the hunt, looking out for high yielding investments which have a decent credit profile, right? And by doing that, right, you will also be able to get proportionately part of the return made by that asset, right? So we look at it a little bit more detail when I explain it through a few illustrations. It might make it easier, right? So as I said, a unit trust is a type of investment that pools money from multiple investors and uses that money to buy a diversified portfolio of assets, right? And each investor in that unit trust owns what you call a unit, right, which represents a portion of the assets of the trust, right? And basically the value of one unit or a unit, right, is determined by the value of the entire assets in that portfolio divided by the number of units outstanding. Let's look at it a little bit more detail through a few illustrations, right? So this is how unit trust works, right? So let's say, for example, hypothetically, there's 5 investors, right? And all 5 of them invest 20 million rupees each, right? And say, for example, Capital Alliance Unit Trust is pooling this set of investors together, right? So 5 investors at 20 million rupees each, the fund is collecting a total of 100 million rupees, right? And then the fund goes and invests in multiple products, right? Say, for example, in this example, we've taken the assumption that the fund invests in 4 particular products, right? Let's say, for example, 25 million rupees in debentures, 25 million in fixed deposits, another 25 million in securitization, and let's say another 25 million in government bills or bonds, right? And at different returns, right? So one investment is making a 20% return, the other one at 17, one at 30%, that could be like a treasury bond, right? And a 25% return on some other investment asset class, right? So they pooled money from 5 investors and invested in 4 different products, right? So typically as an investor, what you would have probably done is taken your money and just been able to buy one particular financial instrument, right? Now what is happening is you are getting access to 4 different products, right? Now this is a hypothetical scenario. In an actual real life scenario, it's not 5 investors, it could be hundreds and thousands of investors, right? And the number of instruments that you invest could be more than 10, 15 in terms of the instruments that you're investing, right? So if you look at the right-hand side, it shows how much returns that each of these instruments are making, right? For example, the first 25 million is making a 5 million rupee return, right? Likewise, the second one is making 4.25 million and so on, right? So the fund is making a total return of 23 million rupees, right? So now as an individual investor, how much am I going to get, right? So the total return made by the fund is 23 million, right? Coming from the different instrument asset classes, right? So the return is 23 million on a pool of 100 million that the investors have invested, right? So effectively, in this particular case, you're looking at the investors making a 23% return, right? So if I had been one of them who had invested 20 million rupees as an investment, my return would be roughly about 23 million into 20%. I will get my portion of that return, which is going to be 4.6 million rupees, right? So this is how the unit trust concept works. You're pooling investments or funds from multiple investors, right? And investing in a diversified pool of assets, right? And for the assets that have been invested, you're getting a proportion of that return based on the amount of money that you have invested, right? Hope I'm clear with that. Right? And so now out of the 23% return that is made, obviously the unit trust fund charges a minimum fee about 0.5%. There are a few other charges like custodian and trustee fee, which accounts for another 0.25%. So effectively the net return that individuals make will be about 22.5%, right? So this is a hypothetical example in terms of numbers. We'll have Shehana present what CAL's numbers are, but I'm talking about unit trust in general, how the concept works. Right? So how is this unit price computed? Right? So now we know how the return works. How is this price? How does this price work? Right? So basically, this unit price is calculated by dividing the total market value of assets. Right? So now in our case, we had 100 million that we had initially invested, which had grown to 123 million at the end of the year. Right? Assuming that you were holding on to your investment for a period of a year, right? Minus any of the fee, you take that market value of assets, right? Or what you call as a net asset value of a fund, right? And divide it by the number of units outstanding, right? So that's how the unit price works, right? I've shown a sample example of how the unit price is that you see on a typical newspaper or even a website, right? But I'll explain to you how the concept works, right? So in example number 1, I'm talking about a unit trust that's, let's say, for example, is providing a net return after fees and all that, a return of 20%, right? And let's say the holding period was 12 months and no one has taken their money out for 12 months, right? So you have funds, what you call as closed-end funds, where you might be locked in for a period of time until where you can't take the money out. You can only sell your units to someone else if you're exiting, right? So in a fund where withdrawal is restricted, let's say, for example, right? How does this unit price kind of work, right? Let's say, for example, initially from multiple investors, we've collected about 100 million rupees, right? And let's say at the inception, this number of units has been created. Let's say 10 million units have been created. This number can be anything. The number of units can be anything, right? It can be even 1 million. So the price changes based on how many units you want to create. It's like how you create shares, right? It depends on if you want to create 1 million shares, the 100 million will be divided by 1 million. So if you want to have 10 million units, right? The 100 million will be divided by 10 million units and the per unit will be about 10 rupees, right? So here in this example, we've taken a total value of 100 million, right? And assumed the issued number of units at inception is 10 million, which means 100 divided by 10, 10 rupees is the price of a unit at inception, right? And now we are saying that no one is withdrawing money for a period of time, right? So in this particular example, we are saying, okay, what is the value going to be in 3 months' time, right? So if you're making 20% return for 12 months, for 3 months, you will make a 5% return, right? 20 divided by 4, right? So value of the 100 million in 3 months' time is going to be roughly about 105 million, right? So what is effectively your unit price is going to be the market value, which is 105 million, divided by the 10 million units, which means that the unit price is going from 10 to 10.5 in 3 months' time, right? So the appreciation in the price is reflecting the return made by the unit holders, right? So if you take 10.5 and divide it by 10 minus 1, that is the return that you made for 3 months, right? And then you annualize it, you get the return for a year. Also keep in mind that when it comes to unit trust, the return is not fixed, right? Because there are people who come in and go out every time, and also the investments keep changing, right? So the return is not fixed. What they quote as return normally is the return which is running right now, or the annualized yield, which is there for the last 3 months or 6 months or 12 months, right? So be careful when you're interpreting the returns. Returns which are shown right now is not a representation of what the returns are going to be in the future. It's an indication. You can look at what kind of daily returns are running right now to get an indication of what rates will be there in the future, right? So this is example number 1, right? And if this particular, the fund lasted for 12 months and no one withdrew, the value of the fund will be 120 million rupees at the end of 1 year, which means 120 million rupees divided by 10 million units will work out to 12 rupees at the end of the year, right? So the 10 rupee unit has gone to 12 rupees at the end of the year. That 10 to 12 increase is reflecting the net return made by the investors, right? Let's look at example number 2, right? So here we are talking about a unit trust fund where you can withdraw money anytime, like a money market fund or an income fund, right? Which is what you normally call an open-ended fund. In an open-ended fund, you can take money whenever you want, right? So you can withdraw money, you can put in money whenever you want. In a closed-ended fund, you can't do that, right? So let's say look at the same example, but now let's say at the end of 3 months, we are seeing one investor who had 1 million units is withdrawing his money out, right? So what would happen, right? So similar to last time, 100 million rupees of assets will be worth 10 rupees a unit, right? And at the end of 3 months, the 105 million will be worth 10.5, like what we did before. Now someone is taking the money out, right? There is an investor who is redeeming or withdrawing 1 million units out, right? It's like a bank deposit, it's taking the money out, right? So what happens is, at the end of 3 months, right, a unit was 10.5 rupees, right? So when he's withdrawing 1 million units out, right, 1 million into 10.5 will be withdrawn, right? So the value of the fund, right, will fall from 105 to 94.5, which is the gap of the 10.5 million that we're talking about, right? And the number of units will come down to 9 million units, right? Obviously, there was 10 million units before, and one person with 1 million units withdrew, right? So the effective unit price will remain the same because there's no change, right? The value of the investment has come down, and also the unit price has come down, right? So just because someone is withdrawing or investing more, the price of the unit doesn't change, right? So this is how the price of unit is computed, right? So now let's look at, if we have unit trust prices published, how can you calculate the returns, right? Say sometimes there is a bit of ambiguity in terms of figuring out, okay, when you see adverts and so on, people question, okay, are these returns correct? Are these returns reflecting the current picture, right? So if you want to, you can actually do this computation and check it, right? Even on the CAL site, for the CAL funds, you can go and check what the unit prices are, what was it, say, on a particular date before versus now. And based on that, you can figure out what kind of returns that the fund is running at the moment, right? So we look at something called an annualized yield, right? An annualized yield basically means, okay, we are taking the return for a particular period that the unit has made, right? And if, say, for example, the return was for 3 months, we annualize it for 365 days, right? And compare it against a 1-year product, right? So let's look at an example, right? So I've taken the example of the CAL Fixed Income Opportunities Fund, which had a unit price of 26.1958 at the end of last year. And as at 30th March 2023, the unit price has increased up to 28.0431, right? So the price appreciation has been about 1.8473, right? So how do I calculate the return, right? So first I do what was the current return, or what is the current unit price, which is 26.0431, right? Oh, sorry, 28.0431, right? And 3 months ago, or roughly 89 days ago, the price was 26.1958, right? Minus 1. So if you take the current price, take the 3 months price before, minus 1, you get the return for that particular period, right? Then what you're doing is, that return is for 89 days, or from 1st of January to 30th March, right? So I'm taking the 3 months return and dividing it by 89 for the number of days and multiplying it by 365, right? Which gives me that return of 28.92, right? So you can take the two numbers, you can take any date, right? For example, it doesn't have to be 31st December as such. If you want to see more realistic current numbers running, you can even take the returns running 2 weeks ago, right? And compare it with the current return, then annualize it for 365 days. That gives an indication of what kind of returns the portfolio is running at, or what the yields that you're kind of making right now, right? So to be honest, this is in line with the rates that you're kind of running out. Now the rates are between 28 to 32 kind of percentage on the fund that we're talking about here, right? So the other one, if you want to compare your returns against what you call the AER, or the annual effective rate, it's almost similar, but when it comes to annual effective rate, you need to compound the returns, right? Because in a unit trust fund, your daily returns are getting compounded, right? Because you're earning interest on a day-to-day basis, right? Compared to a fixed deposit, if you don't hold your deposit until maturity, right, you might not get the same interest at the end of the period. There will be a penalty if you're taking money ahead of time, right? But with a unit trust, you don't have that, right? You will still get whatever the return that is accumulated on a day-to-day basis at the point of withdrawing your funds, right? So there is no penalty just because you withdraw on a particular day, right? This is applicable to normally money market and income funds, right? So taking the same example, right? We take the two prices. First, we look at what the return was for basically the return for the 3-month period, right? So which is 28.0431 divided by 26.1958. That is the return for 3 months, right? What we are going to do is, without dividing it by 89 and multiplying it by 365, we are going to compound it, right? So when you're compounding it, basically it's assuming that every day that return is compounding. It's like 1 plus whatever is getting compounded every day, right? So to look at how it works, right? So we take that return, right? We make it to the power 365 below the number of days that we've invested in, right? Basically, what this effectively means is, if that 1 point whatever return or the 7% return was for 3 months, right, or 89 days, what is it for 365 days on a compounded basis, right? So if you look at that return will work out to about 32.24%, right? This is the return that you will typically compare when you're comparing it with a bank deposit, the AER rate, right? So now you can calculate your own returns, right? So you don't have to wait for a unit trust fund manager, and whenever you have doubts, right, use your computation. You look at, because if you go to the websites, you can go back and see whatever the unit prices were a couple of months ago, a couple of weeks ago, right? But I would suggest not doing it on a very short period. Don't do yesterday versus today or 1 week versus today, right? Because unit prices doesn't necessarily always go up in value, right? It will only happen, it will always keep going up in value only if it's a money market fund, right? In a money market fund, right, because instruments are not mark to marketed, or it is all invested in less than 1 year instruments, right? And there is no deterioration in price as such over a period of time, right? But when it comes to income funds or equity funds, there is a possibility that prices can go down in the interim, right? For example, if this particular fund had invested in shares, right, when one particular share comes down, the unit price can come down, right? Similarly, in the fixed income funds, right, there might be small differences because interest rates go up and down. Say, for example, like what you know, if you are investing in treasury bonds, right, you know that when interest rates go down, the price goes up, and vice versa, right? When rates go up, the price comes down, right? So say, for example, from yesterday to today, if rates had slightly gone up, you'll see a reduction in terms of the price, right? But it doesn't mean that that reduction will be there continuously, right? Because if you buy a bond today and hold it until maturity, right, you will get that return over a period of time, right? So don't look at the daily volatility. I know it's a little bit complex in terms of the explanation, but simply saying, don't look at the daily returns, right? Look at more like a monthly or a 3-month or a 6-month return to look at what is the kind of running rate in your portfolio right now, right? So this is how pricing of a unit trust kind of works, right? So let me come on. So now you understand the basic concept of unit trust, right? So what types of the unit trusts are available, right? First, what you have is something called a money market fund, right? A money market fund only invests in instruments less than 1 year, right? Which is, it can be like a 1-year deposit, or it can be a 3-month treasury bill. It can be a 3-month commercial paper, right? So it invests in fixed income instruments which are less than 1 year, right? And because large part of those investments are going into short-term securities, the fund is able to give you overnight liquidity. When I say overnight liquidity, you can withdraw anytime, at any particular time when you want, right? Because if you look at a typical profile of a money market fund, large part of the investments will be almost at a maturity of less than 3 months, right? So as an investor, you might be able to kind of withdraw the amount of money that you put in on an overnight basis. If you inform them today, you might be able to withdraw tomorrow, right? So that's the kind of liquidity a money market fund will give you, right? So money market funds are almost equivalent to a savings deposit, right? But the return is slightly lower than what you would get on a typical income fund. Let me explain what an income fund is. right? So income funds can invest in more than 1 year instruments as well, right? So for example, it will have a large part in less than 1 year securities, but also will have a large part in long-term instruments as well, right? Why unit trusts kind of create an income fund is because sometimes, particularly in periods like this, when rates are high, you would, as a fund, you would want to lock in your rates, right? When rates were running at 30% plus levels, you would want to lock in your rates with a government bond running at 30%, right? So an income fund gives you the opportunity to do that, right? You can't do that in the money market fund because you can only invest in less than 1 year securities, right? So in an income fund, right, the fund has the ability to make slightly higher returns than a money market fund because part of their investments will be locked in longer term instruments, right? But that doesn't mean that those funds will not be able to give liquidity as such or overnight withdrawal facility as such. Up to a certain level, those income funds will also be able to kind of provide that overnight liquidity to you. So the returns that you make on an income fund is slightly greater than what you would make on a money market fund. And also, the other thing I would want to stress is that here, because you're investing in treasury bonds and so on, that daily volatility will be there. So don't look at daily returns when it comes to income funds, right? Money market funds don't invest in long-term securities. They only invest in short-term securities. Because of that, daily returns, looking at daily returns might not be a problem, right? But with income funds, if they're long-term securities and they are mark to market or they have a price which changes to interest rates, right? Looking at daily returns might not be the greatest option. Right? There is another type of unit trust, which is gilt-edged funds. Gilt-edged funds only invest in government securities, treasury bills and treasury bonds, right? Because government bills and bonds are, you can sell it or trade it in the market. They're more liquid than the traditional money market or income funds, right? And typically, treasury instruments are considered risk-free. Because of that, right? You are basically investing in a risk-free instrument, right? But now with a lot of talk about debt restructuring, it's a bit of a question. But more or less, it is considered a risk-free instrument, right? Similar to how they invest in fixed income unit trust funds, funds can also invest in listed shares, right? If the fund is investing in listed shares, that's what you call an equity fund, right? The problem with equity fund is that you might not be able to get liquidity as what you, so you can't just withdraw whenever you want, right? There will be restrictions in terms of withdrawals, and also returns will be very volatile because equity shares don't always go up, right? So there is a possibility that those returns could also come down as well, right? Then there is something called balance fund, which tries to balance the impact of equity volatility by investing a portion of the fund in fixed income funds as well, in fixed income instruments as well, right? So balance fund has a mix of equity and fixed income instrument, right? The first three that we're talking about is pure fixed income funds, out of which the money market funds and the investment funds are the most popular ones, right? So let's look at, okay, now you know that there's an asset class called unit trust available, but why should you really invest in unit trust funds, right? So the first benefit is that you make a higher return compared to traditional deposit, right? Like what I said, that you're getting access to a set of pool of investments, which you wouldn't have been able to do it by yourself, right? Because your ticket size is small, your investment size is small. Because of that, you might not have been able to make those kind of returns. The second thing is that, how are we really making these returns, right? So I'm showing an example of how a bank works, right? A bank will take deposit from investors, right? People like you who are investing. Let's say, for example, they are taking the deposit at 18%, right? Then the bank keeps a margin. Let's say a typical bank keeps a margin about 5 to 7%, right? And will lend it to the borrower at 25%, right? So there's a company who is borrowing from the bank at 25%, right? And there's an investor who's giving money to the bank at 18%, right? So there's an investor and a borrower, right? So what happens in a unit trust is the unit trust is basically directly going to the borrower, right? It's directly going to the borrower and says, hey, I'll lend you funds. I'll give you a lower return than what you're going to borrow from the bank, right? If your borrowing rate is 25% from the bank, I will lend you at 22.5%, right? So your borrowing cost is lower, right? And then what the unit trust fund does is, they take that money and keep a margin as management fee, a very small margin as management fee, and give the return as 22% to the investor, right? So if you look at it, it's a win-win for both the borrower and the investor, right? So the investor has made a higher return. Investor was only making 18% on deposit. Now he's making 22% on a unit trust, right? It's the same exposure at the end of the day, right? The borrower, on the other hand, who was borrowing at 25%, is now borrowing at 22.5%, right? By doing this, both the investor and the borrower are benefiting. So that's how the unit trust fund is able to give investors a higher return compared to what they would get on a normal bank deposit as such, right? So there's so by disintermediating the banks, taking banks out of the equation, the unit trusts are able to provide a higher return, right? Second is obviously the diversification benefits. You're getting access to a wide pool of assets. It's not only FDs, it's commercial papers, securitizations. These are instruments that you might have not seen in your day-to-day work, right? So because the unit trust fund managers are always looking at possible opportunities at a decent credit risk, right? It will be a portfolio of diversified instruments, right? So what is the kind of benefit that you kind of get, right? Let's say, for example, let's say there was a corporate collapse, a company fails, a bank fails, right? Say you had invested 100 million rupees. If you had put all that 100 million rupees in one day, say a fixed deposit or a debenture or so on, right? If that financial institution collapses, your 100 million will be worth zero today, right? Right? Possibly you'll get something from insurance and so on, but more or less your investment value is completely gone, right? If you do the same thing with a unit trust fund, right? So similar, I'm taking the example that we looked at before, right? 100 million invested in 4 instruments, right? So this was the previous example that we looked at, right? Let's assume there is a financial collapse. One company falls, right? Because it's invested in 4 instruments, and only if one company falls, you're still getting the return from the other instruments, right? Unless all instruments fall, which is a very remote possibility, right? The likelihood that all investments will fail is almost next to nothing, right? So you'll still, in this particular case, get the return of the 3 investments which are still remaining. You might lose money on that 17 million and whatever, right? But the remaining returns will come in, right? So your return will be, right? You will get 75 million rupees. You won't get that 25 million capital that you lost, right? You'll get that 75 million rupees plus the 18.7 million rupees that you made on interest on the other instruments, right? Which will give you a total of 93.75 million, right? So even when you have put down 100 million, and even after one company collapsing in your portfolio, still you're ending up with 93.75. So this is the benefit of diversification, right? So even if a portion kind of part falls, you're not going to lose the entire money. And particularly when interest rates are high, the likelihood that everything or you're not going to make a significant capital loss is very restricted, right? The good thing is that in our funds, in Capital Alliance, we haven't seen a collapse or corporate collapse from inception, right? So, but to be on the safe side, we're saying that even on a diversification basis, right, you are very unlikely to lose all your capital, right? You would only lose all your capital if all the investment instruments fail at the same time, which is a very remote possibility, right? So this is the benefit of diversification, right? The other benefit that you get is the expertise coming from the professional fund managers, right? So the fund managers basically look at market cycles, they look at interest rates, they look at how the country is going to move. So they know when to kind of get into markets, when should they go long, when should they lock in their money for long time versus short time, right? As individuals, our awareness of it will be very limited, right? So we are not going to we have our day-to-day work that we do. So following markets and so on will be very difficult, right? So the professional fund managers do it for you if you're being part of the unit trust funds, right? Second is that professional fund managers, because they have access to a large amount of funds, they're able to negotiate better rates, right? So if you go with 1 million rupees to a bank or a financial institution versus a unit trust fund going with $1 billion, obviously the rates that you're going to get is better, right? So that benefit also comes in when you're giving it to a professional to manage your money, right? And the third and the most important kind of thing right now is a credit evaluation, right? There can be institutions which are giving a very high return, right? But what is the credit quality of those instruments, right? Have you really looked into it, right? So here in a unit trust funds, all the investments that are made, there is a credit evaluation process, right? There are fund managers who are going to these companies, looking at those investments, talking to management, looking at those numbers, crunching those numbers, and figuring out which companies are really creditworthy. And they are investing in those companies, right? As individuals, we might not be able to make that process, right? It's very difficult for you to even keep a track of what kind of investments that you're making, right? So the benefit of professional fund management comes into play, right? And like what I said, a lot of the money market and income funds invest a large part of their money in short-term instruments. So I'm showing a typical maturity profile of a sample unit trust fund, right? So these are billion rupee worth of funds, right? And if you look at the billion rupees, I've put it based on maturity brackets, and roughly 550 million rupees are less than 3 months maturity, right? Which means that up to 550 million rupees, the unit trust can give you liquidity within less than 3 months time, right? So it gives you convenience. You can use it like a savings deposit, right? Particularly with money market funds and most of the income funds in Sri Lanka, it's almost like an alternative to a savings deposit. So why do you really want to keep money in a savings deposit, which is running at 4%, when you can make a 20% plus kind of return on a unit trust fund, which is almost like you can withdraw with a 1 day's notice as such, right? So liquidity is an added benefit that you get as a unit trust fund. The other benefit that you get is that it's a regulated product, right? So unit trusts are regulated by the SEC, and also it's managed by, the securities are managed by a custodian. What does this custodian mean, right? So when you're giving money or investing money in a unit trust fund, you're actually not giving money to Capital Alliance, right? Capital Alliance or CAL is just the managers to the issue, right? They're just managing to the money. So when you're sending money, it's going to a custodian or a trustee account, right? In CAL's case, it's basically Deutsche Bank, right? So your money goes from your bank account to the Deutsche Bank account. So it doesn't have anything to do with Capital Alliance as such, right? Capital Alliance, what do? They give you advice. They advise the Deutsche Bank in terms of where those investments have to be placed in, right? And when you're withdrawing money, the money comes from Deutsche Bank to your bank account, right? So there is no process of where the money is coming into a CAL's own bank account as such, right? So that's how there is a control in terms of fraud and so on. Your money doesn't come into Capital Alliance account as such. It goes into a special purpose vehicle, which is managed by a custodian, right? Where the company which is managing the unit trust doesn't have any say to take that money from the custodian account to their own account as such, right? So while a fund's portfolio manager makes trading or investment decisions, the securities owned by the fund are held with the custodian. So custodian's duty is to ensure that the money is managed properly, right? And that there's no fraud and so on, right? So the whole objective of managing your funds through a custodian is to reduce the risk of default, right? We've spoken about this in the last session, but obviously with the current context, there is a tax benefit on unit trust as well, right? When you're investing in FD, every time you're redeeming or renewing your deposit, you will be paying the WHT, and now if you're falling above a threshold, right, you will be paying the income tax on your fixed income instruments as well, right? So if you're a bank deposit, and if you're falling into the higher tax bracket, you might be ending up paying 36% as taxes on your interest income, right? But if you are just holding your money in a unit trust account, right, you can be postponing your tax payments, right? So in a unit trust fund, if you just put your money today and keep it until for a while, for a couple of years, you don't have to pay that tax burden during the year, right? Compared to a fixed deposit, where you might have to pay the FD when you're withdrawing at the end of the year, right? Because the interest is getting accumulated on the unit trust funds. You only need to pay the taxes at the point of when you're withdrawing in the future. So if you're also expecting that these taxes can come down in the future, right, you're better off keeping the money in the unit trust fund, because you will be only taxed the rate which prevails in, say, 2025 or 26 when you're withdrawing that money out, right? So the current tax rate doesn't matter. What matters is the tax rate that is applicable at the time of withdrawal, right? I'm not going into too much detail because we did a separate session on taxation by itself, right? But there is a tax benefit if you just put your money in unit trust and hold it without withdrawing it. You can basically postpone your tax payments. And when in a time where interest rates are very high, by postponing your tax payment, you're really saving up on the amount of tax that you're paying, right? So this is basically what the unit trust kind of entails, right? So I'd be happy to kind of answer any questions with regarding to the unit trust. But before that, let me invite Shehana Dain, AVP at CAL Investments, or from Trust Fund Manager, who will basically take you through what investment products or unit trust products are available at CAL per se, right? And what kind of benefits that you will enjoy being part of CAL, right? Before we go into the unit trust part, let me give a little bit of introduction into CAL. So CAL is a full-fledged investment bank, which has operations in primary dealing, corporate finance, equities, government securities. We are a primary dealer, and also we have we are the largest, one of the largest unit trust managers in the country. And we've been in operation from the year 2000. And we have one listed company, which is more than 10 billion in terms of market cap, which is CAL Treasuries. And we have one of the fastest growing unit trust fund managers or asset management. Our overall assets under management is about 80 to 90 billion rupees, of which 30 to 35 billion rupees is the funds that we're managing through the unit trust. So let me invite Shehana Dain, who will take you through in terms of what's available at CAL and what kind of products and what are the benefits associated with the unit trust as such.
So like Udeeshan mentioned, the benefits of the unit trust fund, I will take you through the products that we have and also the internal specs of how we take the decisions when it comes to investing our investors' money in the separate instruments that we do. So the next slide kind of explains to you why we should actually select or rather why select CAL when it comes to investing in unit trust funds. So the number one pointer is the bargaining power that CAL unit trust funds has. So I don't know if many of you are aware. So right now, currently, CAL unit trust funds, including their private wealth management portfolios, manage assets close to 100 billion rupees. So when you have a 100 billion rupees fund, that kind of gives you a lot of bargaining power when it comes to getting the best rates available from the issuers. For example, just think of yourself in a practical sense. When you have 100,000 rupees compared to when you have 5 million rupees from a bank, the bank actually offers you a very much higher return. So imagine that in a very large scale of 100 billion rupees and what kind of bargaining power and also economics of scales the fund might have. And secondly, when it comes to CAL as a group, we are leaders in the equity market as well as the primary dealership. So when I say that, I think you must be already aware that one of our sister companies, CAL PLC, was listed last year. So it's one of the largest non-bank primary dealers. And also our equity firm, CAL Securities, is one of the top 3 equity firms in the country. So when we have those linkages with the customers and also access to markets, it kind of, gives us a lot of access to the best investment options that are available in the market right now. And number 3 is that we are an award-winning research house. So when it comes to investing and finding the best instruments, investing in a unit trust fund, one of the main aspects is to be very competent when it comes to your research. So our bread and butter is predicting the interest rates. So if we do not predict that in a proper form, that means our fund returns will not reflect the current market dynamics. The research house or the research team has won multiple accolades. And last year also we won the best research house in the CFA awards. And number 4 is the access that UT or CAL has to top corporate finance deals. So we have a corporate finance team, and the unit trust fund, the CAL investments team and the CAL corporate finance team kind of, get together to come up with innovative structures when it comes to investment. So even if it's a long-term investment, we will not simply only focus on a 5-year FD or a 5-year bond. There are multiple aspects when it comes to a long-term investment or a short-term investments that gives the best return to risk ratio for our investors. So let's look at the role of unit trust funds when it comes to cash management, right? it's not just mutual funds, but any investment that you as an investor do is directly correlated to your cash management. So there are three main elements when it comes to cash management, that is operational cash, reserve cash, and strategic cash. So operational cash is something that you are very familiar with. This is the money that we need on a daily basis for our expenses, food, traveling, and many other expenditure, rent. And that is something you want to have access to at any time, right? So the very easy example is the money that you keep in a savings account. And then there's reserve cash. So reserve cash does not have fluctuations as much as the operations cash. So as you might see here, the fluctuation when it comes to reserve cash is minimal. So reserve cash also gets into two different sections here. That is reserve cash 1, which you see major change. When it comes to reserve cash 2, you see a slight change, right? And the strategic cash, that is the investments or the cash that you need on a very long term. That is 6 to 12 months. You don't really need this money immediately. It's more like a rainy day fund. And this is the actual money that you might utilize for a long-term investment. So the changes here happens in a very, it's kind of quite rare. So I will talk to you next on how we have our products that we have at the moment, how these kind of, link to these three sections. So you might, as an investor, personally, I'm quite aware that you might have all these three requirements, right? So do we have a product that kind of meets all these three requirements? So the next slide kind of gives you that perspective. So the three main products, so we have more than 3 products, but I'm going to focus on the 3 most popular products that CAL has. That is the investment grade fund, fixed income opportunities fund, and the quantitative equity fund. So when I spoke about the cash management situation earlier, so the operational cash aspect, right? So that is the cash that you want on a daily basis. You want to have access to that almost instantaneously, right? And that is where the investment grade fund comes into play. So the liquidity aspect here is very high, the risk is low, and the objective is operating cash. The reason I'm saying the risk is low is because the investment grade fund is the only fund in the country that has been rated A by Fitch. So that kind of gives you a little bit of assurance when it comes to the safety of the fund, because Fitch Rating is an external party, as you may know, and they have rated as A. And the YTD annualized return is 26.89, which is far higher than any rate that your bank savings accounts can give. And you can actually invest today. Let's say you invest on a working day and you want to withdraw the funds on, let's say, Monday. That is possible. So let's talk about the fixed income opportunities fund. Here, the risk is low to medium. So as you know, the returns of the funds vary from low risk to high risk. So it's a rule of thumb where high the risk, high the return. So the risk here is low to medium, and liquidity is also medium. So when I say medium, it's not really medium. So I'm talking about the fixed income opportunities fund where you need to keep your capital tied in for a period of 1 month. In the grand spectrum of things, this 1 month is a very short time period, right? And the objective is reserve cash. So the annualized return for the year is 28.9%. Again, way higher than any term deposit or savings account can actually offer to you. So the final fund that I have here is the quantitative equity fund. The equity fund that CAL operates has recorded, or rather last year has been the best performing fund across all our peers, and currently is offering 52.59% as the annualized YTD yield. But I need to keep you guys informed. The equity fund is very volatile. As you know, it kind of follows the market patterns, and still for all, the ASPI index YTD is minus 24.56%. Compared to that, the fund has recorded plus 52.59%. That kind of gives you insight as to how the management decisions have really worked out for investors, right? So here, risk is quite high, liquidity is low, because there's an exit fee when you need to take the funds out before a year's time period. And the objective here is strategic investment. So let's move to the next slide. Risk management. So I mean, when I talk to you about the returns that the funds are offering, and I'm telling you that we can provide liquidity, and I'm also telling you that the returns are very high, one of the main questions that you might really have is, okay, if the company is giving me this much of return and they are saying that they're giving me liquidity, how can they actually provide that to me? What's the risk involved here? That is a very simple question that investors might have. So one thing that most investors may not be aware of is unit trust funds are heavily regulated. And it doesn't really mean that fund managers like CAL can invest in instruments at their discretion. They need to go through several layers of checks and monitoring to execute, or rather execute, a certain investment. So the risk management here is, I'll just try to simplify a little bit for you. So the Security Exchange Commission is our regulator, and they have given us certain guidelines that we need to general guidelines, and also as a fund, what we usually follow. Any unit trust fund in the country, fixed income unit trust funds, can invest in listed or rated instruments. They cannot invest in unrated instruments if they are not listed. So just to simply put this, a listed issuer a listed debt, a debenture, a fund can go up to 25% in their exposure limit. If it's any other issuer, if it's unlisted debt or any other issuer, just to put it simply, the maximum cap that a fund can go is 15%. If it's government securities, there's no limitation as such, because like we mentioned previously, government securities are theoretically known as risk-free assets. So there's no limitation for government securities. But any other instrument, in general, there is a 15% cap. But if it's listed debt, that is, if it's a debenture in a fixed income investment, you can go up to a maximum of 25%. So that kind of gives you an overview how diversification really works, right? So even if it's diversification, usually in funds as big as what we have, there are around 10 to 15 issuers or companies that a fund invests in. So it's very well diversified. So risk management, to take a step further, how we kind of manage the risk is the fund here, for an example, it's a 100 million rupees fund, and we are monitored or are regulated by the Security Exchange Commission. And like I mentioned earlier, it's a maximum of 15% exposure to any instrument or any issuer. So what happens when it comes to investing is we do the in-house credit research, as well as there's something called investment committee, to which we need to the fund managers, we need to report to them and take approval from them before they proceed with an investment. So once you get the approval from the investment committee, only then can they execute these investments. I will go into a little bit of detail as to who are in the investment committee and how the entire credit research process works. So let's go on to the next slide. Apart from the risk factors, or rather how the fund invests in when it comes to unit trust fund that we operate, another very important thing about the risk mitigation is the role that the trustee and custodian plays. So like Udeeshan mentioned, none of the money actually comes into CAL, or rather we are not a finance company, we are merely a fund management company. We manage the funds. So all the money comes through Deutsche Bank, that is our trustee and custodian, and all the investments are also placed through Deutsche Bank. So the securities, the FD certificates, the commercial paper, documentation, securitization documentation, all of it is with the custodian. And the investor money is also going through the trustee. So at no given point does the fund manager have the ability to uplift investment at their own discretion without going through the custodian or the trustee. So the trustee is responsible to ensure that the fund management company is acting according to the long list of regulations that the regulator has informed the unit trust fund management companies to follow. And the explanatory memorandum also kind of gives you a very detailed understanding of what kind of investment objective the fund has. So trustee is responsible for that. The custodian is responsible to keep the securities safe and sound, which the fund invests in. So the next very important factor is liquidity. So while we give you the highest return possible, we need to maintain liquidity as well. Unlike a bank, it's not very easy for a fund management company to say, I'm going to give you 25% interest, but you have to lock in the funds for 5 years. It becomes a little bit more complex for a fund management company like us because we promise two things to our investors. We say that we are giving you a return of a fixed deposit while giving you the liquidity of a savings account. So that becomes a little bit complex for us. And our expertise lies on how we manage this. So I've taken a very simple example of the fixed income opportunities fund, which is one of our most popular funds, and how the liquidity profile or maturity profile of this fund is right now. So this is as at 20th February, because we are already at we've already passed March 31st. These numbers would have changed by now. But let's look at this as an example, right? So as you can see, almost 40% of the funds are in short-term instruments because as fund managers, we anticipated the rates coming down and we kept these money in short-term funds so that we can go long without any kind of, restriction as such. Because right now, as you all may be aware, the IMF deal has kind of almost finalized and the rates in the markets actually coming down slowly. So in the month of March, we really went aggressively and placed most of our investments in long-term instruments so that even when the rates are coming down in the market, you will not really see this significantly impact the fund returns. So as you can see, around 22% is in between 3 to 6 months. And a big portion of our funds are in investments that are 12 months and above. So this kind of gives you an indication how income funds really kind of, has an edge against money market funds, because like we previously mentioned, income funds have the ability to go long. And while money market funds only have the ability to go on instruments that are 1 year and below, income funds kind of give you like that, it gives you a sweet spot where you can enjoy those high returns for a longer time period, right? Because when we say 12 months and above, most of these instruments are around 5 years and, even more than that. So while maintain the liquidity. Right. So next slide is giving you a little bit of insight as to how we manage our credit research. This is one of the main components when it comes to managing the funds here, because this is where our expertise lies compared to any other bank or any other investment option that you might really find in the market. So when it comes to credit research, what CAL Investments does is they look at the macro overview, because that kind of drives anything and everything below that. When I say about the macro overview, what I really mean here is the interest rates, the exchange rate, and the balance of payments. We look at it from the CAL's overview, and the research kind of trickles down from there. So if we forecast that the rates are actually going to come down from X date onwards, the exchange rate is going to go up from X date onwards, that really impacts our decision making. So simply put, how our decision making kind of really trickle down from the macro environment is our research team kind of did their numbers, and we really forecasted that the IMF deal will kind of come in during these time periods, and it will be some kind of an impact where the rates will come down slowly. So that's why we kept those funds in short-term investments so that we can really deploy it in long-term investments when the time is correct. So once the macro research is done, we do the micro analysis. That's when we kind of, analyze the existing investments that CAL holds to manage those issue exposures. Let's say we have invested in company A, B, C, and D, but because of the economic indication or the economic situation in the country, we notice that company B is a little bit stressed right now because the credit book of that company is very much exposed to leasing or some kind of investments like that. So we might reduce exposure into those companies in the future. Then afterwards, we look at the primary analysis. We have in-depth discussions with our issuers and also to kind of understand where their projections or their revenue streams will come from and which areas they will really see trouble, right? So when it comes to investing, we don't really only focus on finance companies. We can really focus on many other listed companies in agriculture, power and regeneration, logistics. So there's a really vast amount of companies that CAL as an investment house really reaches out to, so that we have the upper hand or the bargaining power when it comes to diversifying the investments. So finally, or rather one step earlier, is that we really need to, once we do all of our analysis, the fund management company really needs to trim down or rather summarize their findings and present this to the investment committee. So it does not only mean that the fund management company thinks about it overnight and then goes ahead and invests. Any new investment, if it has not been approved earlier, has to be presented to the investment committee, and only after the approval has been given that it proceeds with the investment. And also, if it's a completely new structure, new product that the market has not seen before, let's say it's a completely new product that we are coming up with the corporate finance team, we also at that point have to reach out to our trustee, kind of get their feedback. Only after then that we can proceed with the investment. So all these investments have to be informed to the trustee and the custodian, and then only it can be placed. So finally, let's look at the comparisons of the unit trust funds, right? How our returns have kind of, played down across the time horizons from 2017. I'm looking at a longer time period to see because how our performance has been, right? So if you look at 2017 up to 2022, I'm comparing the benchmark of the 1-year T-bill as well as the average weighted deposit rate. So the AWDR, or the average weighted deposit rate, is the average of all the deposit rates offered by banks and financial companies. So if you can see here, I mean, we have always been above almost always been above the benchmarks, and except for this period, because this is when we really saw the bank rates kind of go up really fast. And right now also, as you know, the treasury bill rates are kind of higher than ours, right? So, but we will definitely see these rates come down in the short to medium term, but we have always been above the benchmark when it comes to average weighted deposit rate. So it's difficult for finance companies as well as other companies to match the treasury bill rates at all times, because it was a little bit of an unusual situation that happened in the market. As you may be aware, treasury bill rates usually are the risk-free asset, and there's a premium based on the risk for the other companies. But in the last couple of months, the T-bill and T-bond rates were higher than any other investment instrument available in the market, because the companies or the issuers could not really afford that finance cost on their books. So these, I'm going to give a little bit of insight to who our board of directors are. So we have Dinesh D'Souza, who's the chairman of the CAL Group, and Ajit Fernando, who's the CEO, and Shiromal Kure, who is a director, and Kasturi Wilson is also one of our directors, and Jeevan William, Raju Arasaratnam, Sanjeev Anthony, and Rajita Jayasurya. So I told you I'll give you a little bit of insight to who the investment committee is. That is Kanishka Manakar, who's the chairman of CAL Investments, and also the group CEO is a part of the CAL Investments Committee. And Mr. Karunaratna, who was the ex-deputy governor of Central Bank, and Mr. Shashika Ranasinghe, who's the DGM Investments of Sri Lanka Insurance Company, and Shamali Pereira, who is the Chief Compliance Officer. So next on, we need to kind of, after we talked about all of the benefits and the risk management and whatnot, so how do we get started, right? So one of the main things that we offer that most of our counterparts don't is our systems. And this is the real unique selling point that CAL has, that we have a really flexible system that we can offer to our investors when it comes to fulfilling all of their investment needs. So let's just take a look at this very short clip. So when it comes to creating units, you can do that just in a couple of seconds. It's quite easy. I mean, you don't have to drop emails, letters, you don't have to go to a bank or come to us as such. It's just about, attaching your fund transfer information slip and pressing create and confirming. That's it. So when you want to withdraw the money, again, you don't have to come looking for CAL. It's just very easy again. You click redeem units and select the bank account, which is yours, and just mention the amount and the redemption date. And it will mention to you which date it will come to you, because we have certain cutoffs, and it's usually, if you send it to us by 9 o'clock, you get the funds on the same day. Yeah, so adding a bank account and also getting a balance confirmation. Let's say you want to apply for a visa, and getting a balance confirmation is also possible. And if you want to add a new fund, let's say you only have the investment grade fund with us, again, you don't have to write letters and post it to us. You can do that from the portal, as well as doing a fund flip. Let's say you have funds in the investment grade fund and you see the equity market moving and you want to transfer certain funds to the equity fund. That's also possible through the CAL portal, where you just need to do a fund flip, right? So these are simply some of the very few or rather features that the CAL portal holds when it comes to investing in unit trust funds. There is much more. I don't have time to explain all of those to you today. But definitely take a look at the CAL portal. Signing up is completely digital. You just need to go to the CAL portal and fill in a certain form, and you can start your investment journey almost without any kind of physical interaction. And even after that, when it comes to managing your money, we made it very much easier for our investors that they can, do their investments, look at their portfolios, all of it just at the comfort at your house. So we are open for any kind of questions and answers. So just type in any kind of questions that you might have, and we'll be more than happy to explain any kind of concerns that you might have.
Thanks a lot, Shehana. Couple of questions have been, I think there's a fairly substantial amount of questions which have come our way. We'll try to answer most of it, which almost have similar kind of themes running. The first question is on what kind of risks are associated with the fixed income opportunities fund. In terms of the fixed income opportunities fund, in terms of risk is basically credit risk, right? So if at all, if one company fails or you see any company going bankrupt, you have an impact. Or second is if there's some kind of restructuring, and if there is an impact to either the treasury bills, treasury bonds, or even the company that we're exposed to in terms of credit risk falls, that will be impacted. But if there is something of that sort, keep in mind that it's not only capitalized, the entire financial system will be under distress. Yes.
So the main difference between the investment grade fund and the fixed income opportunities fund, yes, it is credit risk. So the investment grade fund, as it's explained in the memorandum, quotes can only invest in investment grade instruments, that is BBB minus and above. Investment grade instruments are, in simple terms, what a credit rating agency may quote as investable assets, right? The fixed income opportunities fund does not have this restriction. It can invest in any listed or rated company, but still for all. So for example, the investment grade fund may have a larger proportion of A-rated instruments, while the fixed income opportunities fund may have a larger proportion of A- rated instruments, so that it can get that rate uptick.
Thanks, Shehana. I see a lot of questions being asked on local domestic debt restructuring and what happens to unit trusts and also in terms of the financial system and so on. I'll briefly explain in terms of where we stand today. So from what we mentioned 6 months ago, our stance hasn't changed in terms of how we're looking at domestic debt restructure, and which is basically that there will not be a major impact in terms of to your investments as individuals. And if you look at the IMF document which came out last week, or based on the governors and Lazard's commentary, it is very clear that they're not going to touch individuals in a large manner. And also, even to the banking system, they are stressing the fact that they don't want to do anything which will be quite detrimental to the financial system as such. So to give a little bit of more guidance in terms of what they're talking about, they very clearly mentioned that when it comes to treasury bills, only the component of treasury bills held by the central bank will be subject to domestic debt restructure, right? So any other treasury bill held by individuals, banks, corporates, all of that is going to be exempt from the domestic debt restructure process. So this is why, if you look at it from last week to this week, you've seen interest rates or the one-year T-bill come crashing down from about 24-25% to now almost at 20% right now. So this is the kind of outcome that we were expecting, and it has kind of now made publicly mentioned by the central bank governor and Lazard's at a press conference held last week. But on the treasury bonds, slightly different in terms of wordings how they put it. They've said it's a voluntary offer and it will be a selected pool of investors which will be targeted for a domestic restructuring program. So when you say voluntary means that if you really don't want to take the restructure, you might not have to do it, right? So for example, in Ghana, the domestic debt restructure which concluded in a month and a half ago, the retail investors were considered a voluntary component, right? So if a retailer was holding on to treasury bonds and so on, right, they had the option of, if they want to, they can take the new bonds at a lower rate, right? Or else they can just hold on to the old bonds until maturity, right? So when it says voluntary, even not only the retailers, even the other components, other holders of treasury bonds have been mentioned that will be falling under the voluntary component, right? So there is a very small probability that retailers or even large part of the institutional investors will be exempt from the domestic debt restructure. At least this is how we kind of read the interpretation which came out from the central bank governor last week. And a lot of it is positive, to be honest, from their wording and the kind of debt reduction that they're kind of expecting. A lot of it is in the form of maturity extension. And what they're saying is that large part of the maturity extension will come from the central bank, right? Where central bank bills will be converted to treasury bonds, which are most likely going to be more than 10 years, right? So in terms of the progress, what happens next is the IMF has partnered with two independent bodies who are doing a asset quality review on the 5 top banks, right? So keep in mind that the 5 top banks are, you have your Bank of Ceylon, People's Bank, Commercial Bank, and a few other banks. And these banks obviously are exposed to especially the top 2 state banks are exposed to the government sector. They have treasury bonds, which they bought at low rates. So they're already falling almost short of capital in terms of capital adequacy. So whether it makes sense to do a restructuring on those whatever will be very difficult, right? Because you're going to penalize guys who are already under stress right now, right? So which is why they are being very specific and saying, if it's going to be detrimental to the financial system, they're going to kind of keep that out of the parameter of domestic debt restructure, right? So it's going to be a very small pool of people who are going to be affected by the DDR. And to be honest, there is an order of priority in terms of normally how IMF looks at it, right? So in terms of who the first component that will be touched, if at all, first will be the central bank, then will be what you call as a superannuity funds, which is your EPF, ETF. Then you have banks and finance companies. Then you have institutional investors, corporate investors, and finally only have retailers, right? And how the IMF looks at the unit trusts, because they are held by retailers, normally they fall in the category of retailers, right? So unit trusts will be falling under the category of retailers in most of the scenarios, right? So the probability that they will be subject to a DDR is very remote, I would say, right? And drawing from what we've seen in Ghana last month, even though banks and finance companies all were subject to the DDR, the individuals and the unit trust funds were left out, right? So here in Sri Lanka's case, I think it's more clear in terms of that there's a very likelihood that a lot of the investors will not be kind of penalized, apart from the external creditors who are going to be penalized in a large way, right? So the other question is on as I understand, CAL's custodian bank is Deutsche Bank, which is in trouble right now. Shares dropped nearly 30% in the past 3 months. What are you planning to do to mitigate the present custodian bank risk? So this question has come in from a lot of people. When it comes to the custodian bank, if there is stake, say for example, a particular custodian bank defaults, right? Even though deposits will be locked, right? Money held by the custodians in terms of the money managed by funds and so on is a separate SPV altogether, right? So anything happening on that, there won't be a locking of funds or you're not being able to withdraw. That doesn't happen with that funds. These are treated separately compared to deposits. It's not part of their balance sheet. The money that is held by the custodian bank is not part, is an asset of the bank as such, right? So this is treated separately. So the SPV continues to fund. If at all, if there is a problem, those SPV funds can change from one custodian to another, right? There can be a transfer of custodian. But obviously from our side, we are continuously monitoring the situation. And obviously if there is a necessary that we need to shift it around, we will do that. So we are on the ball in terms of what's happening around. And And we are from our side taking those necessary steps in terms of mitigating the risk. But from a general perspective, I can say that custodian money held by custodians is not treated similar to how deposits are treated during a default. What will be the minimum investment for unit trusts, and will there be a small deduction for tax in terms of unit trusts? So minimum investment is 1,000 rupees on the unit trust funds. And in terms of tax deductions, there is no tax deduction from the point of the investor. So there is a WHT which is already deducted by the fund. So basically, the fund manager is paying the tax. What you see as return that we publish is net of the 5% WHT, right? But obviously, when you're filing for taxes under income tax file, you're supposed to declare your income, any fixed income deposit or any unit trust or any fixed income instrument return, and obviously pay taxes on it, right? But when we send money to you, we obviously know there's no deduction of tax as such, right? The fund manager has already taken care of the taxes, right? That's reflecting in the unit price already, right? So there is no additional 5% or any tax deduction as such when it comes to the unit trust funds. The other question is, in a unit trust fund, or are earnings in a particular period are automatically accumulated or should be reinvested by us to the same fund?
No, you do not need to reinvest it. So if you do not withdraw it, you earn interest on a daily basis anyhow. So there is no need to uplift and invest altogether. When your funds are in the unit trust fund, let's say you invest it today, and by tomorrow you invest 100 rupees today, and tomorrow due to unit price your balance goes up to 110. The day after tomorrow you earn interest on that 110 rupees. So you don't need to reinvest it all over again.
I'm not exactly sure what this question means. Fixed income, each deposit, we have to wait for 1 month or initial deposit only. So I think what they're trying to mean is whether you just invest or whether you have to keep on investing on a monthly basis.
You need to keep that 1 month whole period for any new investment. Let's say you're investing 1 million today. That is the 2nd of April. So that capital needs to be held until 2nd of May next month, and you can withdraw it any given day on afterwards. But let's say you invested on the 15th of April, then that particular investment, then that 1 month is calculated from that particular date. So yes, each and every new investment, there's a 1 month hold. But once that maturity of that 1 month is passed, then you can withdraw it.
Next question is, also please understand how the return, as in how it builds up and how can you gain from it. Example, if I put in 100,000 rupees today at a fund price of 20 and I want to withdraw full amount in 18 months, how much would I have gained at the time of withdrawal?
So that depends on the unit price, like Shan initially mentioned in the example. So it completely is determinant of the unit price when you're investing and when you're trying to withdraw it. So basically, when you're investing in a trust fund, you're buying the units, and when you're withdrawing the unit from the unit trust fund, you're selling the units back to the fund, right? So if there is a plus difference, let's say you bought at the unit price when you're buying it is at 25 rupees, and when you're withdrawing it after 18 months, the unit price has become 27 rupees. So the price difference between the units, and like we mentioned earlier, you need to calculate the absolute return from the unit price and annualize it to 365 days.
Next question is, are the returns of unit trusts liable for WHT?
I think we answered that earlier. There is a component that the withholding tax is applicable to, but there is also another part of it you need to understand. So government securities are not liable for withholding taxes. And right now, the funds hold a certain component of government securities. So it's not a very direct 5% deduction as such. Only the investments that are not government securities are applicable for this. And the returns that we quote are after the withholding taxes are deducted. So the 29% return you saw on the fixed income fund, as well as the 27% return you saw on the investment grade fund, are all after the withholding taxes and our fees, and all of it is deducted. That's what you get.
What is the maximum amount we can transfer to your account?
There is no limitation as such. So you can even transfer 1 billion rupees if you want today.
I think if it's a bank account, online transfer, I think there might be limits on your banks.
Yes.
Right?
So if I think online banking, there's a limitation based on your personal bank, maybe I think 1 million rupees a day or something like that. But to RTGS transfers or real-time gross transfers, there is no limitation as such that I'm aware of. So we get certain investors actually invest a couple of billion rupees with us on daily basis, and as well as certain small retail investors even invest 100,000 rupees, such amounts as well.
There's a question on why don't have an index fund in Sri Lanka as such. So to be honest, index funds mainly, I think there's nothing in terms of a lot in terms of fixed income that we can benchmark to. But in terms of equity funds, the problem is that buying the ASPI or having linked to the S&P 20, to be honest, in Sri Lanka's equity markets have been so volatile. So you have to be very you only make money, to be honest, if you pick the right stocks. By just buying the index, to be honest, historically, if you look at the returns, you haven't generated too much of money, right? So for example, if you're invested in 2011, just after the peak of the run in 2011, the index was about 7,800 or so. And 10 years later or 11 years later, your index is still at about 9,000, 9,300, right? So if you are just invested in the index fund, to be honest, you wouldn't have made too much of money in equities, right? In Sri Lanka, when it comes to investing in equities, you have to be right in terms of investing in the right shares, pick those right shares. Second is time the markets perfectly because, or time the markets as much as possible because the volatilities are so high, and also by holding on to your securities, you haven't been really making too much of money in the long run. So you have to move from share to share. Passive investments have not really worked very well for Sri Lanka.
Just to add to that, it's completely correct what Shan is saying. That can actually be seen through our quantitative equity fund. If you look at the ASPI on year-to-date basis, it's earning a negative 24%, if I'm not mistaken, compared to our equity fund, which does not go on hand with the ASPI, has earned a plus 52% return on an annualized YTD basis.
So there's a question on fund withdrawals, which include both capital and interest income. In capital and interest income, how is tax calculated?
So all of the taxes that is mentioned, withholding taxes, is specific on instrument basis. So we are unable to tell you right now what are the exact instruments that are there, but through a withholding tax certificate, you might be able to see what kind of tax deduction has happened for your particular investment.
So in terms of what you have to pay as income tax has to be paid on the returns. If, for example, if you invested 100,000 rupees today, and 2 years down the line, that 100,000 has become 150,000 rupees. On that 50,000 rupees, you need to pay your income tax for the 2 years based on the tax that is prevailing at that time, right? So you pay on the return. So you don't segregate between capital and interest, particularly when it comes to fixed income funds. You pay on the total and declare that as your return.
So if you're an investor who withdraws money on a frequent basis, monthly interest of that nature, you might be actually paying a higher tax in this time horizon because the tax regime is very stringent right now. But let's say you decide not to withdraw that interest component and let the unit trust fund continue up to, let's say, three years or 2 years, and then the tax regime actually kind of gets a bit relaxed, then you might be actually seeing a much more benefit.
As per your explanation, our funds are invested in different products, including fixed deposits. Please, can you elaborate on how you allow redemption money in the short term if invested in fixed deposits?
So that I actually explained to you on the liquidity profile. Just as we have fixed deposits, we also have a very large proportion of investments that are short term. So when it comes to fixed deposits, it's not just a plain vanilla fixed deposit that we might have. So like I told you guys earlier, we structure certain products with the corporate finance team. So we request from our issuers, because we have the bargaining power, we tell them, okay, fine, we'll give you 2 billion rupees, but we want a flexible plan when it comes to the maturity. We tell them, okay, for 1 year, it's fixed, but after a year, we can withdraw at any given time. So based on the volume that we provide to our issuers, as well as the structuring capability of the corporate finance team, it's not just a plain vanilla FD that we have that you might see, that you're kind of familiar with when it comes to banks. our structuring capacity is different. So we kind of go long, but with certain annotations and certain conditions with our visuals.
I think we're running short of time and there's questions coming in. What we'll do is I think we'll share our email address with you, and you can write to us. If you have missed a few questions, I see a ton of questions coming in. If you can share the questions with us, we'll be happy to respond to you. Thank you so much for joining in on a Sunday morning. I know it's a rest day, but thanks for joining in, and hope to see you in our sessions ahead. And please let us know if you want feedback or if you have any feedback, and if you want any particular topic that you would want to kind of listen to us in the sessions ahead. Thank you so much, and
thank you so much.
Have a great day.